Hello and welcome to the Financial Bunny TV. My name is Nicolette Vashile, also known as the Financial Bunny. Now we've got something really cool that we're starting on this channel, and that is to try and create some sort of financial predictability for you. We want to make sure that you secure your financial future. But how do we get that right? Well, we got to do it through consumer financial education. And today I'm joined by somebody absolutely fantastic. I must say, I met him on a set of, it was Sanlam Mula Money Family Game Show, right?
That is correct.
Absolutely fantastic. His name is Teddy Sibuyi. Let me give you a little snippet of who Teddy actually is. Now, Teddy Sibuyi is an authorized principal and senior financial planner at TT Mba Financial Services. He's the author of The Importance of Your Financial Planning. It's my financial planning. And the winner of Beat the Pro at the Sunshine Tour Golf Tournament. Tell me a little bit about golf.
No, golf is one of those things where, the work that we do, sometimes we get stressed out. So it's nice just to be out there, one, of course, for networking is good. For your health, because, we walk a lot. I think on an average game, you walk about 10Ks. So most of the time, we don't have time to go to the gym. So one, for health and for networking, and just, we call it the mental washing machine. So I think it's good for the mind as well.
So it's getting your steps in. But
Exactly.
ladies and gentlemen, please welcome Teddy Sibuyi to the show.
Thank you very much. Thank you, Nikki.
Teddy, before we get into the show today, we're going to be talking life and living annuities. But before we get into all of that, I'd like to play a simple game with you. It's called Save or Spend.
Okay. Wow.
Right? We're going to put your financial literacy to the test.
All right.
So we're going to pick a card. I think you can start. It's as simple as playing 30 seconds.
All right.
You're going to describe what's on the card for me, and I have to figure it out.
All right.
But please, man.
I'm bad at
That's
30
all I'm going to
seconds.
say to you. Please, man.
I'm bad at 30 seconds, unfortunately.
No, oh, look, some of them are upside down already. You can't be bad at 30 seconds. You can't be bad at this 30 seconds because, first of all, it's not 30 seconds. Secondly, it is something you know.
Okay, let's go green.
Okay, let's go green, savings or investments. Okay, let's go.
Okay, so must I tell you what it is?
You have to explain what's on the card.
Wow, explain what's on the card.
Yes.
Okay, okay. So when you invest your money, it needs to be put elsewhere, What is that called, Because you put your money, you give it to your insurance company, but they have to take the money and put it elsewhere.
Into the market.
Yeah.
Okay.
But what is that? Like, what is that?
Investments.
Yeah, perfect. So you in the market is fine, and then in the markets, but where do they put it in, What are those vehicles that they use,
Investment funds, mutual funds.
Yeah, perfect. Yeah, there we go. Yeah, no, that's fine. You got it right.
First and foremost, let's just be clear here. You have 30 seconds to explain these things. You can't be explaining like that. You got 30 seconds to do the whole card.
Oh, okay.
Okay,
Yeah,
so
okay.
I'm gonna roll an actual timer for you here,
All right.
so that you do this in 30 seconds. Okay, are you ready? Hold
Yes.
on. Let's get the timer
I
running.
think we have to get a new one. I think this one you got it right.
Yeah, I got one right, Teddy.
Yeah, the
One.
market and then asset allocation there.
Okay,
That's fine.
let's go. We're gonna do 30 seconds for you. Let's roll the clock. 30 seconds. Okay, so pick another card.
This time let's go blue, my
Blue.
favorite color.
Okay, are you ready? 1 to 1. To start.
Okay. If you're at work, you get some benefits, so that when you pass away, your family gets something. That is called?
Death benefit? Fringe benefits?
Nope. Yeah, that, but there's a word for it, if there's a group of people that are part of
Employee
it.
benefits.
Another word for it?
I don't know.
For life cover. It basically covers life covers. If you're part of an employer, when you pass away, all that,
Group life.
there we go, group life. And of course, if you invested and then there's a certain value, if you want to check how much your money is doing, that is called? You invested, you call your financial advisor, financial planner, say how much is my money. That balance that they gives you is called what?
I don't know what you're saying in time. It's 30 seconds. What is it called?
The market value,
Aibo.
Yeah.
Aibo. Yabana ukuthi you're explaining like a finance person. Let me do a card.
Please do.
Let
Please
me
do.
do a card and let's see how it goes.
I told you I'm better at these
Because I'm
things,
like,
unfortunately.
what is he explaining to me? Okay, let's go. Let's do general. Okay, are you ready?
Yes, I'm ready.
1 to 1 to 15%. What do we call that? That we pay
Tax.
to SARS. What is it called? 15%.
Oh, VAT.
All right. He used to be the minister. Okay, first and foremost, his surname at the end is an animal in the water, right? His first name is a Japanese a city. He used to be an old minister in the ANC. He married a very young girl. She was 19.
Oh, my word.
His name is a Japanese city.
No. I'm lost.
Time.
No, I'm lost.
You're not talking Sekgwale.
Oh!
But you know what, Teddy? Let's
I'm
put
better
these
at
away.
this.
We'll play this a little bit later
Yeah,
on.
we'll do.
As I mentioned, when it comes to retirement, normally people have two income options, and
That's
that's the
correct.
life or the living annuity. And today I want us to get into a little bit of that because I want to talk a little bit about how do you preserve wealth and how do you transfer wealth to your generations, right? Now, we know that in the retirement space, there's been a new reform, and it's called the two-part retirement system
That's
that
correct.
comes into play on the 1st of September 2024. But I think before we get into all of that, let's talk a little bit about retirement. Why is planning for retirement so important?
Okay, that's very important because you are not going to work for the rest of your life, right? And during your working years, while you're working, you accustom yourself to a certain lifestyle. And preferably, what you want to do is that at retirement, you want to maintain that standard of living. And that, unfortunately, is only possible if one, you plan for it, beforehand and in time. And that's why you also need to consult because of most people contribute for the sake of contributing without knowing well why if, for example, there's a shortfall or surplus. So when you consult, say, this is the lifestyle that I want to live in retirement. So based on what I earn right now, how much do I need to put away? So that is to make sure that one, you retire comfortably. And unfortunately, in South Africa, the sad reality is only 6% of people can afford to retire comfortably. That means those that can actually maintain the standard of living that they used to. So that means 94% are not able to. So that's why it's very important. And one of the things I think you can do even as a parent or a guardian, is to actually start for your kids from the moment they're born.
Okay.
What most people do not know is that the moment your child or your nephew or niece, the moment they get a birth certificate, you can actually start a retirement for them.
Oh.
That is actually a wonderful thing because you are giving them a good 20 or 25-year financial advantage. And when they start working, it's a nice, wonderful handover, I've done a couple of those handovers. It's a wonderful and emotional thing. So listen, I've started this retirement for you from birth. It's been active for 25 years because, you can contribute from as little as 200 Rand a month.
But are they contributing into an actual retirement
Actual
fund under the
retirement.
Pensions Act?
Actual retirement,
Okay.
So the child becomes, of course, the the policy holder, but the parent or the guardian, they become the payer.
Yes.
So when they start working, you give it to your niece or your nephew or your child or your son. You say, listen, I've started this for you 25 years ago. Now, here it is. There's 2 million, there's 3 million because, you and me, when we started contributing, we started on zero. Imagine if our parents started for us where, now you take out a retirement, you start on 3 million or 5 million. Like I said, we're all going to retire, So it's good to actually give that financial advantage. But the critical part is you don't want to be a burden on the state because when you are a burden on the state, guess what happens? All of us have to cover that bill. So that means our taxes go up and that becomes a problem. But if everyone does it as early as possible, it becomes easy for everyone. And of course, when you start working, imagine what a wonderful conversation it is, with your child annually, when you do the reviews. To say, listen, it's sitting at 500,000, I'm contributing for you, and this is why I'm doing it, And when they start working as well, say, okay, your fund value, the market value is sitting at about 2 million right now, you can take it over, It is a wonderful thing. And I said, I've done a number of those, and it's actually a wonderful thing to do.
I like that. And there's a couple of questions that I'm thinking about as you're talking about it, because I think traditionally a lot of us, we are told, open a TFSA. That's probably
correct.
the best one to open for your child when they're born, right? So I want to park that for 2 seconds. But there was something you say that I think that kind of stood out, and I think it stands out for a lot of South Africans, is the retire comfortably.
Yeah.
What is comfortably? Because I think we all have different needs and wants.
100%.
So what constitute as comfortably?
Now, that is relative depending on the person, but comfortable for you is whatever lifestyle that you are used to right now, Because some people, some people can be able to cover all their living expenses with 10,000, Some people, when they retire, they don't want to retire in Gauteng. They just want to go back to their homelands, Me, I'm from Mpumalanga, I'm from Bushbuck Ridge, Ludlow to be specific. So, so some of us, even right now, I'm still young, but I'm planning for my retirement, I've got to stand that side. I'm going to start building, So I'm already planning for that. And that's that, the cost of living is very low compared to be, for example, here in Gauteng.
Yes.
So someone else, that's relative. Someone else, it might be 10,000. Someone else, it might be 50. Some it's 100. But it has to do with how much you're earning. The good number is about 65% of whatever basically you are earning right now. Because mostly, you're not traveling to work anymore. That back and forth is gone. You're no longer contributing on your retirement annuities. So a lot of costs that, for example, you're incurring right now, about 60% of, oh, 60, I mean, about, I would say about 35% of them, 35%. I mean, when you retire, those are no longer there. So you always want to aim up for about 70%. I mean, I think that's a good number.
I love how I love how you paint a very ideal picture. But what we've seen is a lot of South Africans take debt into their retirement.
That's
Home
true.
loans, student loans, they're making more kids which still need to go to university in
That's true.
retirement. So how do you manage that?
So one of the things I think, because most people, when it comes to retirement, they only depend on the one that they have with their employer. I always say it's actually good to have, aside from the one that you have your employer, have at least two. Because with your employer, you're likely to retire at the age of 60. So have a retirement that pays out at the age of 55.
Okay.
So that one, talk about your debts, that is to settle all the debts that you have, while you're still working. Remember, I know that, of course, as the 1st of September, a couple of things are going to change.
Yeah.
But as is currently right now, so let's say, for example, I've got 3 million. When I turn 55, 1 million will pay to me, as a cash lump sum. And then the two I'll have to, of course, purchase an annuity. We'll get to that. So that 1 million is the one that will settle debt and cover all those things, But you are still working. And then that 2/3 of it, you can buy, of course, an annuity while you're still working. So one, you retire at 55. That is the one, a retirement annuity that you take out in your personal capacity. And then, of course, you're still working. At 60, you get the one that you get from your employer,
Okay.
And then you can still, one way you can contribute, and then that one you pay at 65. So you want to have two, one pays out 55 and 65,
Yes.
and then the one in the middle is the one that you retire from your employer, And now I know that even, for example, life covers, where even though it's a life cover, it has got actually a cash component where the money gets invested for you on your behalf, and it pays to you actually when you turn 65 as a lump sum, and it pays out tax-free. So I know, I mean, I don't want to be basically like product specific pushing here, but to something called, for example, if you've got a life cover with Sanlam, there's something called a wealth bonus. So every month, every premium that you contribute towards your life cover, depending on your age, a portion of it gets invested on your behalf. And then every 5 years, you've got an option of to access 5% of that. But if you don't want that, of course, it grows. So, for example, even if you say, what, I don't have enough money for another retirement annuity, but I can only take one with 55. That is perfect. But if you've got a life cover, make sure that it's got a wealth bonus. Because 55, you exit it. At 60, your employer exits that one. And then at 65, provided, of course, you're still alive, and God has kept you, and then that one pays out. And that pays a lump sum, tax-free. So it can be 2 million. I mean, if you contribute something like 1,000 or 2,000 where you cover yourself and all your family members, you might actually come at 65, you got a good 2, 3, 4, 5 million that pays to you tax-free.
I want to tell you something, and I like what you started, and it's probably me digressing from today's conversation, but you spoke about a part of your life insurance policy going into an investment, right? Which I think often a lot of people get confused about when it comes to insurance in general, right? Now, insurance, we understand, is insurance. If you don't incur a loss, it is not going to pay out. But you're introducing a new concept now. You're saying there's a potential that you could have an insurance policy that, yes, it's still going to cover you if you incur a loss.
That's correct.
But has an investment portion to it.
That is correct. That is correct. And that is actually a wonderful thing because, and over and above that, I mean, back to the point of retirement. So if you have it, it pays that. But if you also have retirement on top of that, it gives you a booster. It's called a retirement booster because now you've got both things, And if you've got medical age, I know I said I don't want to push product, but if you've got medical age, specifically bonitas or fat health, there's even a greater booster that's called, a medical booster.
Okay.
So as I said, this is just there to say, what, this thing of, because that's why most people don't have life covers. Like, what is the use, It's not going to pay to me, it's going to pay to people. Listen, I want the money to come to me. So this basically product says, what, while you are alive, the money will come back to you. Every 5 years, you can access 5% of that. And if you elect for the early access portion, when you turn 65, it pays a lump sum. And for the fact that it pays tax-free, because one, your family is covered. So on that part, I mean, you got peace of mind. And two, I mean, you did not pass away. So when you turn the age of 65, and this, by the way, is not cashback because, I mean, there's a big difference. Remember, cashback, you only get back the premiums that you paid.
Yes.
The money I said is invested for you.
Yes.
I mean, I stand under correction. I think it's about, the average rate of return is about 4%, in the market for that.
Okay.
So that is money that, and when, I mean, I said, you can always speak to your own financial planner to do a consultation for you, and they can actually show you the numbers, And of course, if you do not, I mean, we can always exchange details at the end of it. But speak to your financial planner. I think that is actually a wonderful thing because, like you said, we don't have much money. There's so much debt. So So every bit counts, every bit helps as well.
And I like what you spoke about, like you and I are starting at zero, and most of the time we're actually under contributing when it comes to our retirement.
100%.
I did the retirement calculator the other day and I was like, you know what? I might need to build wealth somewhere else because this is not going to work for me. Only this on its own is not going to work. But I want us to
100%.
get back into the conversation. We're talking annuities, living and life annuities. You mentioned something quite key. You get 1/3 of your money at retirement as
correct.
cash, and then the 2/3 you have to buy a pension, right?
correct.
Or an annuity. And I think that's almost sometimes confuses people.
That it
So
does.
let's talk a little bit about that. If you don't have this, ofola laini for mudende. If you don't do this.
That is
But if you
correct.
do this, you need to buy. What are the differences between the life annuity and the living annuity?
Perfect. So, we say annuities, but the easy word for it is just income.
Okay.
So when you're working, remember that your employer basically pays you an income.
Yes.
But when you retire, you become your own employer now.
Yes.
Now you have to pay yourself an income.
Correct.
But the income that you pay yourself, it has to do with this, part that you've basically accumulated over your working life. So in this example, let's say I retire with 3 million. 1 million, I say I'm going to access in cash. That pays, of course, into my account after taxes, of course. SARS always wants their share. And then the remaining 2 million, I can either purchase a life annuity or a living annuity. So the life annuity is the guaranteed one. So for the clients that are very conservative, the ones that don't want to take any risk, the life annuity is for you. So here's guarantee. From day one, they'll tell you, this is how much we're going to pay for, you on a monthly basis for the rest of your life, escalating at this every year, which means every year it will increase at a certain percentage. Of course, with your financial planner, you'll have discussions at the percentage that is suitable for you, between 0 and 7%, right? So this is guaranteed for life. This one pays every month. But this is ketile. Life annuity, you can't make any changes.
Okay.
You cannot make any changes. Once you select, that's why you need to be sure about it. You need to consult with your financial planner. Most companies have access to them. If you don't have one, you can always reach out and say that we're going to leave our details here. We do these consultations for free. Make sure that you are sure, because once here, this is
done.
You cannot make any changes.
What happens when you die?
When you die, and that's a very important one. So with life annuities, traditionally, they've got guarantees. So for example, let's say I retire with that example of 2 million. The minimum ones are about 5 years,
Okay.
Other insurers say they push them about to 30 years. The 30-year one, I think, is best if you're going to go for that option. But 5 years, I'm going to use 5 years because that's basically the basic in the industry for most of them. So if I've got a guarantee for 5 years, let's say I've got no spouse, right? And if I've taken a 5-year guarantee and I've taken a single life, because there's a joint life or single. So single life, if, for example, I pass away year 4,
Okay.
remember that the guarantee was that
For 5 years.
For 5 years.
Yes.
But remember that they guarantee me income for the rest of my life.
Yes.
However, it's got a 5-year guarantee. So if I pass away year 4, since they're giving me a 5-year guarantee, that means the income still needs to pay for the next year to make it 5.
Yes.
So then in that plan, I will nominate someone to say, what? Should it happen that I pass away before the
5
guarantee,
years.
the 5-year guarantee period, the income needs to go somewhere else, right?
Okay.
So it will still pay for that year. If I pass away year 3, it will still pay for the next 2 years.
Okay.
But of course, at the end of that
5
5th year
years.
term, it stops.
Okay.
So that's how the life annuities happen, If it passed away after the guarantee, then of course it falls away. However, now come to...
No. Hold on. I live up to 7 years. So the 2 years is not paying.
Yeah, if you take that guarantee, that's that. So that's what happened. But now, it's a good thing. I like what you're doing right now. So now, there's a solution to this. So
Okay.
other companies do not have, others do. So that's why I consult with your financial planner and see if where you invested, if they have that option. There's an option called capital preservation.
Okay.
So saying I'm going the guaranteed option,
Yes.
where the income that I'm going to get is for the rest of my life.
Okay.
It's going to increase, of course, annually, so
Yes.
that I'm good. But when I pass away, the amount that I actually, the lump sum that I took to purchase whatever income I purchased, in my case, I said I'm using the example of 2
2
million.
million, yes.
That money will never be lost. It will never be lost. So that one will go to whoever I nominate. So when you pass away, that 2 million will pay to whoever your beneficiaries are.
Oh, so in the 5 years, they're using the 2 million to generate the income you get every month.
Yeah, so that's what happens.
Okay,
Yeah.
okay.
And that is if you take the 5-year guarantee. So others now, because people are complaining a lot, I'm like, listen, I've worked so hard for my money. If I pay, like you're saying right now, year 6, all my money is gone. So
Yeah.
other insurance companies, they went back to the board. So you know what? Let's actually give an option where if those want to give guarantees, there's a guarantee option. And then we also have a preservation option.
Okay.
So the preservation option is not the guarantee option.
Yes.
The preservation option is, you know what? This lump sum that you're purchasing this income with, that one will never be lost.
Yes.
When you pass away, you're 1, you're 5, you're 10, you're 20, that's what your family will get.
Okay.
But in the meantime, of course, while you're alive, for the rest of your life, remember, you're guaranteed an income that pays you on a monthly basis, monthly, month end. And as I said, so that one is nice because whatever lump sum that you have,
You'll
it can
still
never
be
be
able
lost.
to-
So it gives
yes.
you that peace of mind. One, if you want a guarantee and you're a conservative client.
Okay.
But this one I said is ketile, you can't change it.
Okay.
Then on the other hand, then you've got the living annuity.
Okay.
When you talk about, in my case, legacy, when you want to create legacy for me is to say I want to leave something for my kids and I want that thing to grow. You know, that's how we define it, so that they can have it and also leave it for their kids and so forth. You know, so that's what I mean by legacy. So with the living annuity, this one is a problem if you're not disciplined. It needs a disciplined client.
Okay.
Discipline from one. Remember, here you can only get ketile, you can't change. You only get paid monthly, mostly month end. This side you can choose, say, listen, I want to get paid on a monthly basis. That means you get 12 payments a year or quarterly,
Okay.
you know? So that means it's 4 payments every 3 months, right? Semi-annually, that means every 6 months, twice a year, or annually.
Okay.
So that is that, you know? And the withdrawal as well. So remember, this side you can withdraw anything between 2.5% of the capital amount. So it's between 2.5 and 17.5%. That's what you can do here. So, and every year you can choose. Let's say, for example, the first year, you know what? Like with the example you're using, you take this option at 55. You say, you know what? I'm still working. I don't need all the income because I'm still working. Let me take the minimum possible, 2.5.
Yes.
That is actually good because that's like, for example, let's say at work you net like 20,000. But your lifestyle is 15,000. That means there's an extra 5,000 that goes in back to the investment, you know? So if you take 2.5, you know, and your investment, let's say, generates 7.5, that means there's a 7.5 that goes back into the investment. That's how your money grows, you know? That's why this needs discipline. Actually, personally, anyway, I don't think your withdrawal rate should ever be more than 5%. 5% maximum, because then like money goes in. Because if you withdraw more than that, I mean, I've got people who withdraw more than that, like 17.5%. We advise against it because in the same example, that is like you grossing, I mean, like netting about 15,000, but you live a 20,000 lifestyle. Back to the debt issue. That means now there's a 5,000 deficit every month that you need to get elsewhere. But in this case, guess what happens? You start to deplete from the capital. And the money gets depleted very quickly. And then people go social media, they blame companies, these people ate my money. And it's because you were not disciplined. You know, and I mean, I actually have a situation right now where client 1.4 paid into the account. We say when I start minimum, like, listen, 1.5 is too much money for me. It will sustain me for the next, 4 or 5 years. We sat down, we did a budget. Everything was, well, 5-6 months later, I mean, the money's gone. What happened to it, I mean, he's going here, he doesn't want to disclose. And then it's a problem because then that is the money that was supposed to sustain you. And now you have to depend on the 2/3 we're talking about. And now, remember, we're taking the minimum. And as I promised him, the money grew. But now he's opting for the maximum.
Of course.
And now he doesn't want to do monthly, he wants to do annually. I'm like, you could not.
Because he wants the lump sum.
He wants the lump sum. And once a year, I'm like, 1.4 million, that could not last you a year.
How is this going to last the 17?
Exactly. And now this person, they want to go to social media and all this. I'm like, listen, you need to understand it so that one, you can make the most informed financial decision.
Yeah.
It's going to help you so much. So that is so this one is nice if you're disciplined. Say, I won't withdraw more than 5% because everything grows. And every year I say, listen, this year I want to get monthly. Next year I'm like, listen, let's review. You know what? I was taking 2.5, let's make it 4,
Yeah.
It gives you that flexibility. But this one, remember, is got exposure to the market.
Okay.
So your money can actually get depleted if you're withdrawing too much and if you are investing aggressively. So I think the funds that you select, you have to be quite cautious, Excuse me. You have to be quite cautious because if you go very aggressive, and that means high exposure into the markets, especially with equities, and withdrawing maximum, unfortunately, that can deplete your funds. And that's another thing because people are living longer now. The last thing you want, is to outlive your money.
Absolutely.
And that's why I said consultations come into play.
So what happens when you die for the living annuity?
The living annuity, you can appoint a beneficiary.
Yeah.
You can have as many, I said, as long as, the percentage equals to 100%.
Yes.
So this is beautiful because most people actually living annuity, if you're disciplined, you might find that you retired with like 3 million.
Yes.
You passed away, you've got 6 million.
Yes.
So
because it's grown.
Because it's grown. Your kids, if they do the same thing as well, then with them, maybe, they take it at 6, it's about maybe 20 then,
Yeah.
Because what happens, you are withdrawing less than what is generating, so the money is going back, you know what I mean? That's the discipline. But I think a lot of people, see, being able to earn money and make money it's not the same as being able to keep and
money.
preserve it.
Absolutely.
Yeah.
Absolutely. Let's talk 2-point retirement system quickly. I mean, we're not going to go into too much of it, but how will the distribution help? Maybe let's go back a couple of steps. What was the reason to bring about this reform?
So a lot of people, I think, especially with COVID more than anything else, were cash strapped. Like we're saying, a lot of people do not have investments. A lot of people don't have savings, So the only thing that where they put their money is their retirement.
Yeah.
And most people say, I wanted to be able to access it. So because of that, I mean, they put a lot of pressure on the government, like as it's right now, it's going to be implemented on the 1st of September. So that's how the whole thing came about. So it's going to be called the two-pot system. It's actually going to be three because whatever is existing right now, that will stay as is. But as of the 1st of September, no money will be coming to the old one. So 2 new pots will come into play. So for example, let's say I contribute 3,000. From the 1st of September, 1,000 will go into the savings portion and 2,000 will go onto the retirement portion. And then when you're there, remember, let's say I've got like 500,000 on this one, for example. That one, the money will not automatically, in terms of, course, a lot of people say, I'm going to access it automatically, whatever. No. You actually have to consult, speak to, that will not happen automatically. If you want to actually that happen, excuse me, you have to make an appointment. So listen, one, as you know, 10% of it will move to your savings portion, but kept at 30,000. So if I've got 200,000, 10% of that is 20,000. So that I can opt for that. You don't have to. I can opt to move into my savings portion, which means from the old one, I can take 20,000 so that I don't start on zero. I can do that,
Yes.
But if I've got 400,000, 10% of 400,000 is 40,000. They will not allow that. They kept that at 30,000.
Okay.
So I said you can make use of that. So for example, it's going to be 3 pots, the old one and then the 2 new ones. So if on the 1st of September, you say, you know what, I want to opt for that option. You make your consultation with your financial planner and then they'll take 30,000 this side, put it here, you've got 400,000, that's going to be your savings portion. And every month when you contribute, that will now go to the savings portion and the retirement portion. This old one, nothing comes here. So this becomes like your preservation fund, where it's like a lump sum, it will just continue to grow on its own.
But now, after the 1st of September, because the vested pot, which is the preservation pot you speak about, is managed by the old retirement regime.
That's correct.
Can I still withdraw for it if I retire? If I resign?
Yeah, so for example, remember the difference between retirement annuities, and that's another thing also,
Yeah.
Because a lot of people, by the way, say, I'm going to resign so that I can take my money, whatever,
Yes,
yes. No, the old rules still apply. So whatever you can do now, you'll do this side. So this one will not be affected.
Okay.
The only thing is this side right now, as said, because now this is what would happen. And of course, on the savings portion, minimum, there at least needs to be 2,000 for you to withdraw, If there's 1,000, whatever, you can't withdraw. There at least needs to be 2,000. And then, of course, there are no maximums. Once per tax year, our tax year is from the 1st of March up until the end of Feb, It can either be the 28th or 29th, depending on the year. So this side, you'll be able to make a withdrawal, one, full or partial. That is all up to you. But this, I do not advise. I know a lot of people are going to be doing that because, it's my money. But here you get tax according to your marginal tax rate.
Yes.
So what that means is that whatever you earn at work, when you withdraw here, that gets add on top of that, Oof. Which means that a lot of people will get pushed into a higher income bracket.
Absolutely.
So a lot of people, it will not serve them. And more so also I know these are the people that mostly push for it, government employees that are part of the GEPF. Those ones, not only will their marginal tax rate apply, but for them, that might also reduce their pensionable years of service. Which means that, if you're part of the GPF, I won't go into detail that, you know how that works. But your years of service, that's what determines how much basically you earn in retirement. So that might be reduced because you are basically taking to the savings portion. So that's who it's for. I said there's no maximums. You can take whatever you want. But unfortunately, the marginal tax rate, that is what's going to hurt a lot of people.
Here's my problem. Minister Enoch Godongwana was too excited. The Honorable Minister was too excited to tell people, you get your money on the 1st of September. I don't know now because a lot of people feel like they have to withdraw.
That's correct.
Do you get it? Like it's as if Nkare, there's something that's going to happen on the 1st of September and everybody must withdraw.
That's correct.
And it gives me a bit of I'm looking at it from a SARS perspective and I'm like, they're trying to make that 15 billion rand.
They will make it.
and they will make it.
Unfortunately, they will make it because a lot of people are gonna make withdrawals. But I think that's why sessions like this are very
Yeah.
important, so that people can watch, they can consult. And I said, when we're done here, you can consult with your own financial planner, and even companies. I think companies as well. I mean, they should actually get people, professionals, to come and speak to them. I mean, we do free consultations nationally. So if ever your company doesn't provide that, whether you work for private or public, even your company, even if it's like 5 or 10 or 20 employees, and you want someone to come, I said, we're gonna leave our details. I mean, we're more than welcome to come through and we can just break it down for you, because most people are going to make that withdrawal without consulting. And like you said, because remember, the mistake that a lot of people do, they look at the balance of what is there and they start budgeting on that amount.
Listen, they've bought things already.
And then the money that comes into your account is way, way less than what you had expected. And then you start
Absolutely.
crying, because remember that money, before it gets paid out, it first needs to go to SARS for a tax clearance. And then, of course, SARS needs to clear that. And of course, if you're owing from the previous years as well, remember, and some people might end up getting nothing, by the way, because if you're
Because you were
owing
running
SARS,
away from SARS.
exactly. SARS, listen, by the way, we did everything else, and you owe us. You know what I mean?
Yeah.
And then it happens, but rarely where exercise, you know what, actually, we actually owe you, so you'll get so much, and so please make sure that you consult, because a lot of people, if there's 40, 50,000, you think you're going to get that. No, you won't get that amount.
Yeah.
Remember, that tax first SARS needs their own share, and then after that, only then you actually get your share.
Yeah, if it's not clear enough to everybody, you do not need to withdraw from your savings
That is
component
correct.
if you don't need it. And that was why it was created for those who are in actual financial need. Now, last question that I want to ask you is, other financial instruments that consumers can consider if they are trying to preserve wealth, but also most important, and I think you spoke about financial legacy and leaving a legacy. Transferring my wealth to my children.
That's correct.
How should I put that together?
So, okay, and that is a very important one. Now, I see a lot of people who don't fall under the high income brackets.
Yeah.
People are not taxed more than, for example, like 30% going into endowments. You are shortchanging yourself. So if, for example, your income, your tax rate, for example, is 18%, go the tax-free route, because remember, if your contributions are not going to be more than 3,000 per month or more than 36,000 per annum, then there's no need for you that side, because a tax-free investment is tax-free, right? The growth, the dividends, the capital gains, that will not be taxed. You know what I mean? So you want to go that route first, because most people, someone, for example, is taxed at 18%, but then they go to an endowment. An endowment is taxed at a flat rate of 30% in the fund. That means now you are being taxed 12% more than you need to be. So that's why I say first exhaust the tax-free investment one. If, okay, I said, you fall under the low income bracket. But if you fall under the 36, 41 or 45, then endowments are good, because remember then, if I'm taxed at 45%, but I've got an endowment, endowments are taxed at a flat rate of 30% in the fund. So I'm actually saving 15%, So endowments are perfect for that. And of course, you can also put a beneficiary on that. Also with this tax-free investment is the same, but you can put a beneficiary. And with endowments, they also have creditors protection. That means after 3 years, that money is protected from creditors. So most people, business owners, I know they love that one, because their money is preserved, But that is actually quite nice, because it gives you that flexibility. So I think that also depends on, one, your income bracket. So if you've got a high income bracket, endowments are the best when it comes to that. But if you're in the lower income bracket, first, I think exhaust the tax-free, because other people leave money in a bank, a lot of money in the bank. And what you need to know, that if you're under the age of 65, you have an interest-free exemption of 23,800, which means if your interest is that or less, fine, you'll not be taxed. But once it is more, you get taxed. But not only that, back to what we're talking about, the two-pot system on the savings part, you also get taxed according to the marginal tax rate, So a lot of people have money in the bank and then like, I don't work, but I got taxed so much. Why? Because no, you earn so much interest in the bank. That interest get added on top of what you make it work, and that's why they tax you very high, So that is something that you need to be actually mindful of, And of course, or when you're over the age of 65, yeah, of course, that interest-free exemption then becomes a bit higher. But make sure that you consult, because a lot of people, I think, they tax more, not because they're doing the right things, but I think it's just a structure, Where am I putting it? Where am I not? What works and what doesn't? So I think in this case, low income bracket, start with tax-free investments and unit trust. That is quite fine. Once you've exhausted those, then if you're high income bracket, then you can go of course, endowments. That is, of course, while you already have tax-free retirements. Because retirement, especially for parents, we spend sometimes 300 rand on lunch every day, and you can take out a retirement for your child from the moment they're born for 300 rand per month. You spend that on a day. Others, weekend they spend either 5,000. Also, when you submit your taxes, a lot of you are gonna getting mine from SARS. You get 5,000 or 10,000. Even if you don't budget for your kids, you know what? Whatever I'm getting from SARS, let me take out a retirement for my child and lump sum. I'm only gonna fund it with whatever refund I'm getting from SARS. If it's
Yeah.
10,000, I only pay annually. Every year I'm putting 10,000 on this child's retirement. Right now it does not look a big deal, but over 20, 30 years,
It's compounding comes into effect.
100%, 100%.
Returns, dividends, all of that make up.
It makes a big
Do you have
difference.
children?
No, I don't.
You don't have children.
Yes.
Do you want children?
Yes, I do.
Okay, so let's talk about your future kids. What is the one financial lesson you would want to teach them? Literally from the day they are born to the day they leave your home. What's the one thing you would want to drum into them?
Start early.
Start early.
Start early.
Start what early?
Start investing early, start learning early, start making mistakes early, because so many times we wait on doing certain things because you want it to be perfect. When we talked about golf earlier on, when I started, I was bad, but everything else that you knew that you do, it will, you'll suck. But with time, you improve, you get better. So start early. Start, when anything that you want to do, with podcasts like yourself. You started early, some earlier videos, but now it's been refined and it gets
Yeah.
better. But with regards to investing, I think, you want to start as early as possible. I know that's what everyone gets told, but I think just start early. Mistakes are good. Just start making them early and learn and improve. Over time, you find that you've been doing this for a good 10, 20 years. It makes a big difference. It compounds.
Absolutely. It does indeed compound. And I think consistency is probably one of the biggest magical things.
That is the biggest one.
Right?
That
It's
is the
so
biggest one.
magical. Time, consistency, and just keep going at it. Ladies and gentlemen, thank you very much for tuning in. It is the Financial Bunny TV. We've just heard from the man himself, Teddy Sibuyi. If you want to get in touch with him, we will leave his contact details on your screen right now, and that's where you will be able to make contact with him. But from me, Nicolette Mashile, please remember that none of what we say on this channel constitutes as financial advice. If you are, however, looking for financial advice, please do speak to somebody who's certified and registered by the FSCA. I'll see you guys on the next one.
Thank you.